Hello, I'm going to talk this time about a presentation that I'm giving on the 27th of October. It's a discussion of the causes of the Great Recession. I think most people believe that the banks are to blame in some way or other. And some people think the banks are to blame because they're ignorant and greedy and so on. I was rather shocked when I saw this letter in the Times Literary Supplement back in April, where in the Times, the TLS is quite a highbrow magazine and newspaper, and you'd expect it to be responsible. But this letter appeared. Nothing like this to ever appear about simply talking about a poem or a play or something, but they can say this about bankers, you see. Now, it's true enough when you get to academic economists and that views a bit more cautious. And I think what most economists believe is that the Great Recession was due because the banks didn't trust each other. They stopped lending to each other in August 2007 because they were afraid they might go bust. There was then a collapse in confidence, and the end of bank lending and the collapse in confidence then caused a downturn in spending, and that then led to the Great Recession. Now that's a little bit flabby, but I think if you asked most economists, they'd put it in those rather loose terms. They would not link it to a theory. They would not want to sort of bring out a large body of evidence to try and substantiate what they'd said. And this idea that the lack of bank lending was to blame certainly took hold among the world's regulators and central banks. So the Federal Reserve in America said that the banks need more capital, following from the Basel rules. So the banks need more capital in order that when there's again a downturn in demand like this, they can start up lending with no trouble at all. The question here is, was it actually true the banks were short of capital? It was kind of taken for granted that in fact they were very short of capital by previous standards. In fact, the Federal Reserve has long maintained data on the American banking system's capital, the size of capital relative to the assets. These figures are also sorted out with, for example, the Federal Deposit Insurance Corporation. Numbers are easy to get hold of, and then just look at them. The truth is that in 2007, the American banking system had a higher capital asset ratio than it had at any time since 1939. Wasn't short of capital at all. So all that stuff that we had in the newspapers and so on at that time, and also the many books written by some of the key players, for example, Geithner's book on stress tests, stressing the amount of capital that the banks had. This, in my view, all about a lot of nonsense. The American banks had loads of capital. If we want to understand the Great Recession, we must please have a theory. We must have a theory that makes sense in terms of logic, in terms of it fits in with the various categories in the real world, and also which is consistent with past evidence. The Great Recession was a big fall in demand, in spending in a relatively short period of time. These things have happened before. There are theories to explain them. Those theories must be tested against evidence, and we'll see if they work again in the Great Recession. Now, the two main theories that economists talk about in this context are the Keynesian theory, which in its simplest textbook form is that spending is a multiple of autonomous demand, where the autonomous demand is government spending and investment. I'm not going to go through all that now, I haven't got time. I don't have much respect for that theory, but there we are, that is what people are taught in textbooks. And then there's the monetary theory, that the level of national income depends on the quantity of money, and that more or less, in the long run, changes in the quantity of money are reflected in similar changes proportionately in the level of national income and indeed of national wealth. Now, in my view, the monetary theory is the correct one, and I put it to you that if that theory is correct, then banks are central to the story because most money is bank deposits, but it's not true necessarily that banks themselves are to blame for such things as the Great Recession. Let's now have a look at some evidence. The key chap here is Milton Friedman. Friedman and Schwartz wrote the great book showing that in the 1930s American money supply collapsed, American quantitative money collapsed, and then this is the main feature that was responsible for the Great Depression. It wasn't because there's something wrong with capitalism, it was because there's something wrong with the Federal Reserve and the way it carried out its policies. The Federal Reserve essentially was responsible for the implosion of the US banking system. Now, this is a matter of facts. This is what we see. I've used this picture before in these presentations. This is something that shows you the link between money and national income in the G20 economies over a 30-year period. This information is totally compelling. Of course there's a link between the change in the quantity of money and the change in national income. Any fool can see that. This therefore implies that the monetary theory is the right one to be using in the Great Recession. If the monetary theory were correct, you would expect to see a dramatic fall in the rate of change in the quantity of money before or in association with the downturn in demand in the key countries. So first of all, let's look at America. Yep, we can tick that one. Look at the Eurozone. Yep, we can tick that one too. And then let's look at Britain. Yep, that's also the case. In all three cases, we see a big fall in the rate of change in the quantity of money in the critical period 2007 to 2010. Now, there are a lot of caveats, a lot of technicalities, lots of points of detail, and I know that. However, the basic story is correct. Now, the question then is, why did the rate of growth of the quantity of money fall in this way? Okay. And the start of the story is, of course, let's go back to 2006, there was too rapid growth of the quantity of money in America, Britain, Eurozone, and so on. That's the start of the story. Then, in the middle of 2007, the international interbank market closed up. That meant that those banks which had been dependent on interbank borrowing and taking borrowing from other banks to finance their expansion suddenly had to stop growing in the way they had been growing before. It didn't necessarily mean there was going to be a catastrophe, and in fact the world went on pretty much not as before, as it were, but it went until the middle of 2008. There wasn't that much concern about the world economy, and in the middle of 2008, very few people expected the calamity that was about to occur. We had the Lehman Brothers going bust in September 2008, but look, Lehman Brothers is just one organisation. The losses in Lehman Brothers were of the order of $200 billion. $200 billion is a flea bite in the context of the world economy with total annual output of $75,000 billion. Other companies have gone bust of that kind of size before without having those sort of consequences. The key turning point in understanding why the downturn of that period became the calamity, the Great Recession, was the tightening of bank regulation that occurred in September, October of 2000 to date, following the Lehman crisis. In other words, it was officialdom's response to the crisis, rather than the Lehman event itself, that was really critical. What regulators did was to say banks have been misbehaving. We must punish them. We must make them behave like good boys again. And it forced them to hold much more capital than before. And it also said you must have much more capital relative to the amount of lending you're doing. When a bank raises new capital, new equity capital, its shareholders make payments from bank deposits to obtain the new equity capital or the new bonds, whatever it is that the bank issues. The shareholders, the bondholders, their bank deposits fall. So the initial effect of bank recapitalization is to destroy bank deposits, to destroy money. Okay, that's the first thing. The second thing was that the increase in the capital asset ratios that was imposed by regulators caused banks to cut back on their lending, obviously. And you can see this in both America. This shows you figures for the credit commitments that American banks have made. This big drop just in the at the end of 2008, early 2009. That's America. This is the UK. Same kind of story. Big drop in commitments to lend by the banking system just after the recapitalization and tightening of bank regulation. So steps that were supposed, somehow or another, the central bankers thought that the banks would lend more because of all this. Oh, no. The banks clearly would react by cutting back their credit lines. That's what they did. And the result was that those two things, the bank recapitalization and the cutback in lending to the private sector, the growth of money collapsed. Okay. So this is really the key to understanding why that occurred. And it follows that the explanation for the Great Recession is not that the banks themselves were responsible for this collapse in money growth. It's officialdom that caused this dramatic change in the financial environment, and then in the greater growth of money, and then in the... You only will believe this theory if you think that money determines national income. And that's why the monetary theory of national income is so important. That's why I keep on emphasizing these points. Let me finish by saying that I accept that banks did some silly things to run up to the crisis. However, the main cause of the Great Recession was the sudden tightening of regulation by officialdom in late 2008. That's what made the world economy so grim in early 2009. Thank you.